When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Hogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Hogan. And now here's Jeff Hogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Hogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name's Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
I'm doing great. How are you doing?
I'm doing fantastic, thank you. Mid-September here already. Things beginning to cool off a little bit as far as the weather goes. Things heating up, though, as far as the market and as far as the presidential election goes. Hard to believe that, probably about a month and a half or so, we should have an answer as to who's going to be the president. But I think it's going to be a contested election. No matter who wins, the losing party is going to say it's not fair. We're probably not going to know who's the president maybe for, I don't know, it could be on into December, but we'll just have to wait and see. Anyway, that is a discussion for another day. Jeff, they say that interest rates should be dropping here in September. How much do you think that is going to affect investors?
Well, there's a lot of things, and I've mentioned this before, is it's kind of an economic tell that things are not going too well. Every time in history, 7 times in a row that we've had, a yield curve inversion, which is where the 10-year yield is actually less than the 2-year bond yield. And we had that just reverse this last week. Every time that's happened is typically in connection or in conjunction with the first rate decrease after some sort of Fed action like we've had in the last couple of years to try to, curb inflation and correct all the crazy money printing that they've done since Obama took office and thought that was a good idea. Since then, it just seems to be kind of like the modern monetary theory is you just keep printing money and everything's hunky-dory until there's a supply chain crisis or until, we realize that all the rich people that have money are willing to pay whatever they want for stuff and the middle-class people can't. So, the Fed tries to intervene and tries to raise interest rates, and all the interest rates going up really just helps business owners and the wealthy people, or those people that have enough savings to get higher interest, and the poor people keep getting poorer. So, the economy really has not been doing well the last 4 years. Bidenomics is not anything to cheer by any means. It's hurt more Americans than it's helped, other than the rich people that didn't need a lot of help. So, if you already had a lot of money in the stock market, you could do well. If you got out and, sold into these rallies, you're doing well. But, when the Fed gets ready to lower interest rate, it usually means that the economy really isn't cooking along to support these higher interest rates. And we need to lower it because, we're having some problems here. And if you look at the unemployment, it's been over 4% for the last, 5 months now. And it was increasing gradually for 4 or 5 months. Every time that there's been a recession, or every time right before a recession, if you look at, you just look at a time frame of the last 50 to 70 or 100 years, and you see when the recessions, typically they're marking little gray bars, and it'll be a section of time anywhere from, 6 months to 2 years or something like that there's a recession period. And if you look at that, and you put a graph of like unemployment statistics on top of it, typically unemployment rises for 3 or 4 months prior to that. Anytime that the yield curve has been inverted, the recession starts like a month or two after it uninverts. Well, it just uninverted. So, okay, we've got unemployment up, 4 or 5 months in a row. It did tick down. Instead of 4.3 like it was last month, it's only 4.2 growth. It's still bad. It's just not as bad, but it's still bad. It's still unemployment at a level that shouldn't be, especially when you consider that there's a lot of people that aren't even applying for jobs. They've quit working. White-collar jobs are a big loss. Manufacturing jobs are, declining. Every time a manufacturing job is lost, it usually takes 2 or 3 with it because of the other aspects of, what you manufacture, getting it to market, distribution, assembly, and different things that have to do with the manufacturing business. And we've been declining manufacturing over the last 2 years. I think like 22 out of the last 24 months, manufacturing actually declined in virtually every sector in the country. So we've got all kinds of factors. First of all, we got a stock market bubble, first of all, that's going up because they're printing money and they're propping up institutions. And then we've got these economic factors like increasing unemployment. We've got increasing inflation. We've got the Fed having to intervene to raise interest rates. Now they're finally going to start lowering them. It still remains to be seen whether it's 25 or 50 basis points. But, when we're still at the 5 range on the Fed funds rate, we're not lowering it enough to probably make a big difference, other than the fact that the market will think, oh, yay, this is good. Now, let me just explain what I mean by the market. Now, the retail investor is dumb money, meaning that they don't really have the inside knowledge or the historical understanding of, what economic factors and fundamentals and things like that mean. For example, they'll see it as oh, good, they finally lowered interest rates. Well, they've been saying they were going to lower interest rates for almost 2 years now. And every time they say they're going to, the market prices in 1 or 2 interest rate cuts. Shoot, last year, they priced in 5 to 7 interest rate cuts that never happened. So now we have another interest rate coming, and they're trying to price in more interest rate cuts, meaning they keep on raising prices of stock more and more and more. All the while, institutions are decreasing their holdings in stocks, and all the while, retail investors are getting duped into buying more and basically taking the institutions out at a huge profit, only to buy at a high and not have as much investment value as the market is getting choppy and getting ready to probably go into a recessionary phase and some sort of a correction, because bubbles all pop. Every time there's a market bubble, every time there's a historical recessionary cycles, they always complete. We just don't know when. They always happen, but I just don't know the day. So some people are like, gee, Jeff, you've been saying that for a long time. Well, yeah, I'll be saying it until the bubble pops, because we are in a bubble and we have all kinds of recessionary factors that historically have always ended up badly. So, why wouldn't I say, let's just wait to see when those recessionary factors no longer exist. And I think we'll be feel a little bit more comfortable about going back into the market. So back to your question is what happens when interest rates decrease. For smart money, when the Fed finally decreases interest rate, it's basically the Fed throwing in the towel saying, you know what, we can't keep interest rates higher. The inflation is hurting the economy. If we don't lower interest rates, it's going to end really badly. So we better hurry up and try to intervene and start lowering interest rates. Basically, that's saying, hey, this is a recession happening. The yield curve just uninverted. Unemployment is getting higher. Inflation is still hurting the vast majority of Americans. And we've got to do something about it. And almost always the Fed is late to react. And if you look at history, those recessionary periods happen after the yield curve inverts and after the first rate decrease, not before. So they're always talking, we never had interest rates were getting raised and, everybody was screaming recession. Well, we never had it. So you guys are all wrong. Well, look at history. It doesn't happen until the Fed thinks things are bad enough that they have to start dropping interest rates and actually reacting. I think the reason that the Fed hasn't lowered interest rates, even though they said they would, is a couple of reasons. One is it's kind of manipulation for the people in the White House to stay in there and look like they're doing a good job. And, to say that the Fed is not beholden in some way to the White House and somehow apolitical and not a political, arm of any politician or a party is not true, because they do receive a lot of pressure from the powers that be. There's also other factors, like the economists in the White House will, they got this thing they call the plunger team that'll go in and buy futures before the market just to make it look like the market's okay. So it suckers, all the retail investors to buy when really there should be a correction and prices should be going back to a little bit more of what we consider a fair value state. And, historically they always have. So if we get back to fair value, we're looking at about a 50% market correction that would get us back to that range. And historically, we've always gone back to fair market. Right now, we've gotten to a point where the current price earnings ratios, now they're always talking, forward price earnings ratios. We think companies are going to grow by 25% next year. So the forward price earnings ratio is 17. That's in line. Well, no, it isn't. Let's see if companies grow by 25% on earnings and revenues next year. They won't. They haven't. No, we grew by like 1% last year. So, how is it that, GDP can be basically flat and only affected by, the inflation numbers and not really growth in actual, productivity or production, but somehow say that we're going to have all these great earnings because Fed's going to lower interest rates, and they haven't yet. Well, they're starting now. But they've got to lower interest rates, to really make it easy for companies to borrow and to really put more money back into their economic machines. They're going to have to lower interest rates probably by 2, 3, or 4%, kind of get them back to where it was before. But guess what happens then? We go into some more massive waves of inflation, which is counterproductive. It basically eats up all the things that we make. So, from the standpoint of a retiree, looking at lowering interest rates, you think, oh, great, well, I'll make some money in the market. Well, not really. The economy's probably going to get bad. And if it does, after a few rate decreases, we're going to see inflation happen. And we might actually have to see the Fed intervene again in a year or so once things get popping again to where inflation starts becoming a reality. They might have to go through another wave of rate increases in order to curb it. This is just the start of probably, the end of this first market cycle. If we look at stagflation that happened in the 70s with Jimmy Carter, we look at about 3 phases of inflation where it went up. They tried to kind of fix it. the economy got bad, went into recessionary period, then all of a sudden there's inflation again, and the Fed intervened again, and it was kind of a three-phase or three-round roller coaster ride, which may happen again. But one thing I am pretty certain will happen is between now and the election, I think the market's going to do everything, or the Fed and everybody's going to do everything they can to pretend everything's good and the economy is good and try to prop the market up best they can. But I think they've stretched the balloon so far that they might not be able to hold out till the election or till after the election. Most of the people that were calling for this recession to start, 4 to 6 months ago or 6 to 8 months ago are now saying, well, it's probably, might be, first part of 25 because they might be able to just put a little bit more gas on this balloon before it pops, to get us through the election. And that could be true. But what I'm seeing is a lot of weakness in the market. If you look at the tech stocks, which are very interest rate sensitive, and the market gets really excited with this new AI technology and the fact that they're going to start lowering interest rates. But, if you look at the NASDAQ over the last 6 months, it's only up, less than 1,000 points. That's less than 5%. If you look at over the last 3 months, it's actually down about 5%. If you look at the Dow over the last 3 months, the Dow's only up about 1,000 points on three. That's about 3% in 3 months. If you look at the last 6 months, it's also up only about 1,000 points. So you're making about the same as you'd make on a CD for a year on an annualized basis, yet you're riding this roller coaster of stock market craziness. But all we hear about is, stock market's going up. Well, it's kind of been out of gas for the last 6 months or so. We've gotten some recent corrections that, are showing the weakness. And we're also seeing the only thing propping the markets up is market hype and stock buybacks by companies that a few weeks ago when the market was tanking, they came in with $5 billion a day in stock buybacks for about a week in order to stop the sell-off, and it propped it up. Now, this last round of sell-offs, we haven't really seen a lot of these stock buybacks. I think they're kind of out of gas on that. They're just trying to tell us, buy the dips, and, hopefully hype the private investor to be suckers and go in and buy. If you talk about being suckers, I just saw a stat, and this is interesting, that 75% of retail investors are down on NVIDIA, even though NVIDIA is up, 300% in the last year or something like that. Yet 75% of investors are losing money because the average purchase price for the private investor today was $111 a share, and it's trading, I think, around 102-ish this week. So if you're looking at, what the smart money's doing, they're getting out, they're selling into this, they're hyping it. So, while the smart money's unloading positions, and I talk about NVIDIA and I mentioned that before, because it's pretty much is the driver of the market. It's the biggest stock. And if you look at NVIDIA stock pricing and the ups and the downs and just the price action of it, and you look at the chart, it pretty much mimics the entire NASDAQ. In fact, it mimics, the S&P quite a bit too. But, it seems like that's the stock everybody follows. And that stock has shown incredible weakness. We know that the president of NVIDIA sold, can't remember how much it was, a billion in stock or something, some huge number. Bezos has been selling his stock from Amazon. Apple president sold a bunch of his stock. We've got JP Morgan selling. The insiders of the companies are selling their stock while they're still hyping the market, making it sound like everything's hunky-dory. But, they're smart. They know that the yield curve's uninverting. They know that the interest rates are going down on the shorter term interest rate instruments, bond instruments. We still have the short-term 3-month bonds still trading at about 5%. We can still go and get some CDs in the 4 or 5 range for short-term, which might be a lot better than you can get next year. So back to, I guess, to answer your question, what do we think and what's it going to mean to investors, because of these rate decreases? Well, I think the signs are going to be the smart money that, okay, the parade is over, the party's over, go, run for the hills and, try to hype the market up enough to, keep the retail investor engaged so that they can continue to unload stock and let the public be the fall guy rather than the institutions, the banks, the brokerage firms. But, if you want to lock in good interest rates, what we've been doing is we're happy with no risk making 5-ish% on our money, doing some private equity deals that we can make, more on, and taking very little risk in the market while we're waiting for this cycle to shake out. I think the risk is way too high to put money in that you're using for income in retirement or getting ready to use for income in retirement, or you don't want to lose and have to work 5 or 10 more years to get it back for retirement. That safety with the high interest rates has been really good for us the last couple of years. So I guess my biggest concern would be, how fast they drop interest rates so that these short-term liquid money that we're making, in the 5 range on or better, we're not going to be able to make that kind of money anymore. So what do? Can we lock in 5% range without risk while we figure out what the market's going to do in the next 5 or 10 years? There's an index that shows that wherever the price earnings ratio is currently, you can predict the next 10 years annualized rates of return. It's called the Shiller Price Earnings Index. And you can look it up online and study if you want to. But if you look at where the earnings rate, we're in the highest tenth of a percentage that it's ever been. There's only been 2 times it's even come close to where we're at right now, 1929 and 2000. So if we look at, 08 was pretty close too, but every time that happens, we go into a correction phase. I mean, a big market correction phase, and we go back to fair value. If you look at the fact that like the lost decade from 2000 to 2010, the price earnings ratio was about the same as it is right now, very close. And the following 10 years, it made 0. Well, statistics show that the historical of the next 10 years, based on where price earnings ratio is right now, is going to average somewhere between negative 1.8 and maybe 3% on the upside as far as your potential earnings or potential growth range. Well, 2 or 3%, that's not, and that's with a lot of volatility. If you're using money, that's a death trap for retirement income plans. So I don't think we want to be going into the market at this point. We want to be taking profits, and we have been over the last couple of years. We're still at a high point in the market, even though it went higher than maybe, when we got out, when the market started looking ugly a year or two ago. But we're still at a high point considering where the market's going to probably be in the next 10 years. Meantime, how can we lock in higher interest? Well, you can get a CD for maybe a year at 5%, maybe 2 years at 4, maybe 3 years at 3, because that's what they think they can make on the money, or they think the equivalent rate of return will be. Or you can get some annuities that are still pushing almost 5%, or somewhere in that 5% range, and lock that rate in for 5 to 10 years. My opinion is some money ought to be in that type of an investment to make sure that you can lock in the interest rates when they're at, potentially the highest that they might be in for a while. Now, there's another theory that if we do have, some massive rate cuts and then we have higher inflation, the Fed might have to raise interest rates again. And there's some economists that think that the interest rates on mortgages are going to be 7 or 8 or 9% in a year or two. I kind of think that they can do better than that. I hope they can. I don't know if the economy can, with all the extra printed money that they've done over the last 15 years, maybe it's true, maybe they can, but I think that might be a stretch. But I do know that right now we can get higher interest rates than we've been able to get since I've been in this business for 10 or 15 or 20 years. So you can lock in some good, safe money rates that historically will beat the next 10 years of what, our current pricing or overpricing of the stock market says that we should be able to expect in the market overall. So I'm not saying get out of the market. We still like the market. We still like it in times when it's at a good value. I think there'll be a time to buy into the market after the recession finishes this market cycle and we have a good correction. It'll be a great time to buy. The other thing is we use indexed products that lock in the upside in the stock market and don't lose when the market goes down. For example, in that lost decade of 2000 to 2010, where the stock market actually netted 0, there were 5 up years and 5 down years. Well, the 5 up years, you would have made money in an indexed product, and the 5 down years, you wouldn't have lost anything. So you would have, in the worst indexed annuity product or indexed universal life product for LERPs, or any indexed, they don't really have any mutual funds or ETFs that do that. They have to be kind of an insured product where they don't actually risk principal. But on the insurance side, there's many safe ways that we can get upside without downside and hedge the risks in the market. And they can guarantee you income as well. I've talked about that several times in the show. I talk about that with every client that comes in that wants an income plan is how do we guarantee income? How do we make sure we don't lose money, yet we can still take advantage of the upside in the market when it's there, but not lose money when it's not there. They're called fixed index annuities, index universal life. Life insurance companies are very creative in how they protect your assets. They manage a lot of pension money that same way for a lot of government pensions, a lot of private pensions, and they know how to manage money in the market and not take risk because they're insurance companies. They're not supposed to take risks. Now, Wall Street hates them because they're competitive. I like them because it's another bucket that you can fill with money that you can't afford to lose and still make a better than a fair rate of return. Now, when the interest rates are high like they are now, companies can actually give you better participation in the portion of the market upside that you get. If we bought these annuities in a low interest rate environment a few years ago, the upside isn't, nearly as good as it can be now. So, given the fact that we're ready to start lowering interest rates, I think it's a great time to lock in these high interest rates. They might go higher in the future. Some people say they will, but they might not. I hope they don't go higher. I hope they kind of settle down in some sort of a mid-range, not as low as 0 or 1 or 2%, because that's like printing money and it's not really healthy for the economy when you can't make money on savings. But I don't think, somewhere above 5% is very healthy for this economy right now. And, maybe a 3 to 4% might be a nice, happy range, especially if we can get inflation down to 2%. So we can at least be keeping ahead of inflation. Meantime, let's lock in as much as you can at 5 or more, or use index products that have a potential to earn 8 or 10% or better in the good years and not lose any money in the bad years. So I guess that's my long answer to a short question. As usual, I covered a lot of ground right there, but we do have interest rates in a downtrend right now. So let's lock in the best interest if you want on your safe money. Or you can say, yay, we can wait this out. Looks like there's going to be some recessionary factors come. The market may correct like it should. And there might be some great buying opportunities in the next couple of years that we want to get in on the ground floor on the downswing, not the pullback or not the dips. We want to buy at the bottom or at a fair market value when it gets there.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson, and we're talking about what to do before interest rates start dropping. Again, if you've got questions for us, you'd like to have this conversation with Jeff, 520-780-9059 is our telephone number to get your no-cost, no-obligation retirement roadmap. 520-780-9059. Of course, check us out online at premret.com, premret.com. Jeff, just a few more minutes left in this particular segment. What is your forecast for the coming year as far as interest rates go? I know you don't have a crystal ball, but what's your gut feeling about where we're heading with interest rates?
Yeah, I think they're going to have to, once they start lowering interest rates, I think it's going to create a little bit of panic in smart money in the market. I think it's not going to do what, there's a lot of people, the layperson who just hears stuff on the news that says, oh, well, if the lower interest rates, we'll get back to that great economy we had before. All they have to do is lower interest rates. Well, wait a minute. It was the low interest rates that caused all this extra inflation that we're dealing with right now. We haven't fixed the supply chain issue. Manufacturing is down. We're still importing everything that we, use pretty much or more of it. So we've got to fix manufacturing, energy independence, get the cost of transporting the goods to their final destinations a lot lower, which again was here when Trump was in office and had us energy independent. I think that's a big first step. But we've got to fix more than just an interest rate. An interest rate drop doesn't fix everything. Some people think that that's the fix all. Well, it isn't. That's basically what got us into trouble in the first place. We've got to fix a lot of things simultaneously in order to do it. And unfortunately, we've let a lot of that stuff in the last 4 years. The president administration, the White House has not done a very good job economically. Well, most politicians, unfortunately, study political science, not economics, and don't really know how to run businesses. They just know how to get elected by BSing the public and telling us that they're somebody that they're not, and then they get voted in and do whatever the puppeteers tell them to do. It's unfortunate, but we've got in a mess, and there's a lot more to correct before I think things get that much better. But I think we need to, just be very cautious here because I think there's going to be some tough times ahead as far as the market goes. I don't think now's a good time to be too risky. I think it's time to kind of hunker down. I think the interest rates will fall probably maybe 2% over the next couple of, maybe probably year and a half. I think it might start out with a 25 or 50% rate cut, maybe a couple more. So we might go down 1% this year, maybe another percent next year. If we keep going, it's because we're really having some bad economic times, and they may continue to lower interest rates. But as soon as we kind of find that market sell off and some sort of a bottom, and then the economy starts rolling again, we're going to, because of that low interest rate environment, we're probably going to see inflation surge again. And then we're going to be back to the same old, cycle. So, I don't know if it can be handled any different. It seems like history keeps repeating. It seems like, oh, well, this time it's different. We can do things differently. We'll manage it differently. But they never do. They do the same things. They always react. They always do it late. And even though the Fed's supposed to kind of do preemptive strikes in some of this economic planning, they're always doing reactive strikes, or they're always pretending it's not going to be as bad. And then when it is, they have to go a little overboard with everything from rate hikes to rate cuts, and it's always in arrears. So that system has not been proven any different in my lifetime, and even before my lifetime. So, I'm not going to just believe that all of a sudden politicians got smarter, in handling policy with interest. I think Trump has a better chance at it because he does know business. He does know economics. He understands that rate cuts, like tax rate cuts, actually increase economic activity, not hinder spending in the government or in the communities. It actually creates more money. There's a lot of things that I think politicians are disconnected from a business standpoint and an economic standpoint that I wish they would learn, or I wish they would hire people that are a little bit more savvy with economic theory and understanding than, oh, we got to spend more money. Well, let's just find ways to tax more money. Or, heaven forbid, we can't lower taxes. Look at all the deficit spending we're having. Well, yeah, you're getting us into trouble, and all that deficit spending is creating inflation. Now what do you have to do? You have to tighten up the market and hurt the middle class people by making less capital available to them while you're handing it to the banks and the brokerage firms to buy their own stock back and to prop the market up and to make billions and billions of dollars in profits to help the rich get richer so that they'll give you a lot of money in your next election. It's a sad state of affairs, but that's the way it is. And unfortunately, I think the party in power is more apt to want to manipulate the market situation in order to stay in power. And I'm a little bit worried about how things will go with a Harris win. But I think that's what the the Fed and the politicians and the market seems to want. And I'm not sure why, but that's, I don't know. I'm a little afraid about our near-term future here.
If you're just joining us, you're listening to Jeff Hogan. Our show is called Premier Retirement. My name is Jeff Shade, and we've just finished discussing what to do now before interest rates start dropping. If you want to hear the show again, don't worry. We're also a podcast. Just go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show so you can stay on top of your wealth and how to grow it. We're going to take a quick break, Jeff. When we come back, we've got listener questions. Then we'll be talking about what to do before a spouse passes. All that and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shade.
We so much appreciate you making us a part of your weekend. You're listening to Premier Retirement with Jeff Hogan. My name is Jeff Shade. And again, we're on for you 4 times a week in the radio, Saturday, 7 a.m., also 9 a.m. and 1 p.m. And then you can join us on Sundays at 11 a.m. And that is always, we're a podcast. Wherever you get your podcast, search for Premier Retirement. You'll find this show, many of our past shows, so you can stay on top of your journey towards a prosperous and confident retirement. Our telephone number, 520-780-9059 if you've got questions. And speaking of questions, Jeff, let's kick it off this week with Chris listening to us in Tucson. And Chris writes, I have some well-to-do friends who have put their houses in trusts. What is the benefit of putting a house in a trust?
It depends what kind of trust you put it in. Some people put houses in a trust, so it's an estate preservation trust where, you could put it in an irrevocable trust and keep it in your family. Nobody could ever put a lien on it if you ever go to a nursing home or whatever. It's kind of a trick to play, but most people use revocable trusts, which have what's called reversionary rights, meaning the trustee puts it in a trust. You can get it out, you can sell it, you can do whatever you want to, live in it, rent it, whatever you want. But the trust owns it. You're the trustee. And one of the reasons people do that is because the trust, when you die, the trust is still the owner of the house, and so there's no probate. Now, in Arizona, they have a law that allows you to do a beneficiary deed. So if it's only to try to get out of probate, you can do that just by putting your kids' names on the house, and then they just basically all have to sign off on it to get it into their names, and they can do whatever they want with it and split up the money. Some people put a house in a trust or other assets in trust in order to allow maybe one more responsible, fiscally savvy person to manage assets for the rest of the children or heirs that they might have listed, because they don't want each of the kids to have access to, a bunch of money or fight over the house or whatever. So they'll put it in trust so that they can pass on the trusteeship, or in other words, the management of that asset to someone they trust. That's why they call it a trust, upon their death, or even upon their, illness or, final days where maybe they need somebody on a power of attorney to manage that house or to sell it while they're going into a nursing home or assisted living or whatever. So sometimes they'll do a trust in order to basically create a succession plan for those assets. And if that succession plan is documented properly, then you don't have to worry about probate or getting the court's mitts on your property or involved in, litigating or having other people make claims on that property because it's in trust. Now, some people think that a trust somehow protects property from lawsuits and predators and creditors. The irrevocable trust can, depending on if you're doing it in order to hide assets because there's already a pre-existing condition like a lawsuit or something. They call that contemplation, and you can't do it. But in most cases, people use a revocable trust, meaning that they have access to all the rights and privileges of owning that house just as if they would own it in their own names. If that's the case, just because you have it in a trust doesn't mean somebody can't sue you. If you can get in that house and access the equity for a loan or anything else, the court could eventually tell you you have to do the same. And if you have a big house with a lot of equity, sometimes they'll do that. The homestead exemption would protect you for a little bit of that equity, but not all of the equity. Nevertheless, sometimes just having the word trust on a title, may deter some maybe less savvy attorneys or suers or predators, creditors, etc. And so it's not necessarily a bad idea to have it in a trust. We like trust. I'm a certified estate planner. I keep up on the strategies using trusts. I don't write trusts. We have attorneys and doc preparers do all that stuff, the things, but I know how they work in context of, what assets you might want to place in them, whether you want to use a trust as a beneficiary or as an owner, what the easiest way to deal with it is based on your goals. But trusts are very popular. We use them for most of our clients. You don't have to use a trust if you want to just avoid probate. But most of the time, people will get trust because they include other things. They include powers of attorney so that if they get sick, their spouse or kids can make decisions for them based on financial need or even healthcare matters. There's usually a living will, which is the power to pull the plug if you're brain dead or a persistent vegetative state and no longer have need for food and medication. You just want to go and meet your maker in dignity rather than just be kept alive on a machine for a while and have Medicare milked on your behalf for the final days as long as they can keep you alive. So that's another thing that those include. There's also usually a backup will just in case you need a will for court purposes, for probate purposes, in a trust package, generally speaking. Estate planning portfolio is not a dumb thing to do for anybody. You don't have to be an affluent friend or a well-to-do person to, as I think you said in the question, in order to need a trust or to utilize a trust. The trust is really just a way to protect your assets. The other thing you might want to use a trust for is, in our family, we had a special needs daughter, and we had, she's passed away now, but we had a section for her share to be placed in a special needs trust that would remain in trust, that would be allowed to utilize for her benefit, and her siblings would take care of that for her. Would she need extra money, but not ever be able to distribute enough assets to her or her account in order to have her lose any benefits that might be provided by state agencies, disabilities, Social Security, or any government aid that she was receiving. So if you have reasons to protect assets, but you want to set aside assets for special needs children, there's special needs provisions you can do in a trust, and a lot of other things. So there's probably 100 reasons that your friend might have put that house in trust. Most people do it just to avoid probate. You can do it in different ways. But if you want estate planning a consultation to find out if a trust makes any sense for you, you may or may not need one depending on the complexity of your estate or who your heirs are. But it's probably a smart thing to look at as far as, we consider that one of the 5 pillars of planning, not just your investments, but your income, your tax planning, what you do for long-term care in the final days if there's ever a healthcare need. And then, of course, the estate plan, which is, what you do with all your stuff, when you're done using it, how do you get it to who you want, how you want, when you want, with the least amount of taxes, trouble, and, fees and effort. So, it's an important part of a total comprehensive plan. Most firms out there only do portfolio management, don't offer any of those other things. So we use them here. Glad you asked the question. And I think you should probably look into it, make sure it's, if it isn't right for you, you at least know what you're rejecting. And if it is right for you, you should get one.
Chris, hope that answer helps you, and thanks for listening to us in Tucson. We'll send you out Jeff's book, Retirement: The Road Ahead. Again, our telephone number, 520-780-9059, if you want to get in and sit down with Jeff and talk about that trust. Okay, Jeff, next question. Tom in Alta Vista. Tom writes, I own 4 rental houses with a total value of about $2 million. I'm thinking of getting out of the landlord business because of my age and health. These houses generate about a third of my income. I bought them 20, 17, and 15 years ago, so they have appreciated a bit. Is there a way to get around paying big capital gains taxes when I sell them?
Well, if you sell them and you want to redeploy the money into other assets that are not real estate, then not really. Here's the benefit of capital gains taxes, even though there'll be big capital gains taxes, maybe big comparatively speaking, but keep in mind that the government's your partner no matter what you do. Whether you have a job, you get to pay taxes. If you make money in an investment, you get to pay taxes. There's only a couple of exceptions, and one is currently there's a step up on death. When you pass away, you could pass those assets on to your heirs. I don't know what your situation is, whether you're single, married, have children, or anybody you want to leave those houses to. But if you were to, keep them till you died, you don't want to be in the landlord business. I get that. Well, is it worth paying, 20% of the profits of the houses, which, is a lot less than 40% if you would have earned that money in a job or short-term, investments, or even on interest income that might be otherwise taxed at ordinary income? Your tax rate's about half of what it could be. So in a way, 20% of $2 million still leaves you 1.6 that you could reinvest and make money on. Or you could just take your chances, be a landlord, hire out management company to deal with it so that you could still have $2 million in property. Well, assuming it keeps that value. I mean, we have had real estate, when markets crash and economic cycles happen, sometimes real estate plummets too. It could happen that we have another real estate debacle like in 2008. I don't think I'd see one on the horizon right now, although I do think that because of lower interest rates in the past, the inflation on home prices has gone up a little bit more than probably should, and maybe houses are overpriced. Maybe they will reset to 10 or 20% lower than they are right now. In that case, you sell the houses at 10 or 20% loss and you still pay taxes. So, getting out when the market's high and the market's hot and paying taxes, you still lock in gains. I don't think that's a bad thing. However, if you want to use some tricks to where you can still maybe have some passive income, let somebody else more or less manage it, there are things called Delaware statutory trusts where you can do what's called a 1031 exchange to roll those properties into another real estate property, which is an income generating investment property. It doesn't have to necessarily be rental houses. It could be rental apartments. It could be, rental commercial real estate. It could be, 100, AutoZone stores and 15 O'Reillys or something like it. It could be just a real estate portfolio. It could be a certain specific niche in the market. It could be a mall. A lot of things that you could put in these Delaware statutory trusts. And the good thing about it is that you roll the money tax-free. So you get the whole $2 million to be able to roll. You have to use a third-party intermediary and some tricks. Don't just start doing it on your own and find out you botched the deal. If that's what you want to do, go to a professional that knows how to do these. The basic is you have to roll that property, give somebody else the authority to sell it for you and put it in the trust. And then the trust is managed. And you might get a 4 or 5% dividend rate. I don't know if, net of all the trouble and hassle, and the upkeep of the rental properties, if that still, manages to generate a third of your income that you need. But you don't lose the tax off the top. And under current law, there's still a step up in basis when you die. So if you want to leave that whole $2 million plus whatever appreciation might take place in that statutory trust, when your heirs end up, cashing in or selling that asset, or when it comes due and maybe it sells off and you roll it to another DST in another round of reinvesting assets, depending on how old you are and how long these investments last, you may end up being able to pass them on tax-free to your heirs and not paying that capital gains. But that is assuming they don't get rid of the step up in basis on death. And that's one way they can capture a lot of extra tax money and they, I think the government knows that it's easier to tax dead people than it is live people. So, once you're gone, they can go out and claw back money and taxes if they took that provision away. So you might also find that not only do they take out the step up in basis on assets received through inheritance, they could also make capital gains go away and tax you at an ordinary income basis. And if you look at what Kamala Harris has said and other people, the Green Book and even the Biden administration and rumors that have been out, that tax on unrealized gains, could come into play. You could have to pay taxes on higher levels of taxes if you have like excessive, what they consider excessive, assets. Maybe anything over $1 million gets surcharged and doesn't get the capital gains treatment, or gets even an extra tax hit just because you were smart and invested and did better than the next guy. The redistribution of wealth is kind of a program that one of the parties likes a little bit more than the other. I think government, doesn't mind, reshuffling the deck and kind of spreading it out a little bit in general. But I think to bet 20 or 30 years down in the future that we're still going to have a step up in basis and we're still going to have a tax rate on capital gains as low as 20%, I think is far-fetched and kind of, I think it's a little naive to believe that would still be the case. So I do not have a problem recommending that you just pay the taxes at what you know. You can divest yourself from the government participation in your asset, and then you can invest in other things that, maybe a little bit more stealth. I know you said you had some health issues. I really like LIRPs, life insurance retirement plans, or even putting it in an irrevocable trust where you don't have to pay, taxes on any of the gains. You don't have to pay taxes on any of the net distribution on death. And you can basically divest that government partner forever just by paying your taxes now at what I consider a pretty fair rate of 20% or less. So a couple of things to think about in addition to a lot of different answers and options for that question. But again, there's a lot of opportunities for you to look at. And a lot of things I would consider is, do you want to still just kind of hope that the tax rates stay what they are on capital gains or on step up in basis? Do you want a more passive real estate income? Do you like the real estate business? Or do you want to do something that's a little bit more passive, maybe even tax-free and more stealth as far as maybe making other income that you earn less taxable as well?
Tom, thanks for listening to us in Alta Vista. And, of course, you'll get Jeff's book, Retirement: The Road Ahead. And we would love to sit down and talk with you about your situation. 520-780-9059 is our telephone number. Give us a call this weekend. Leave your name and your telephone number, and Shelley will call you back during the week and set up that appointment. Once again, 520-780-9059. Next question, Jeff, is Clay listening to us in Savano. Clay says, with interest rate cuts coming this fall and into next year, how do you think the market's going to react? I'm wondering about my stock market investments and whether I need to adjust that.
Well, I think I answered that earlier in the first segment of the show, what I think will happen. Stock market, lowering interest rates, all the profit in the stock market, I think, has already happened based on what the lowering, how many stock market rate decreases have they already priced into the market? 6, 7, 8, 9, and then they're going to have another one and supposedly it's going to make the market go up. Well, I think that's what, naive investors or people that are, have other jobs and don't really focus on market or history or what happens in economic cycles might think, because that's what we're being told to think by the news, which is propaganda at best and blatant BS at worst. But the bottom line is you don't get a real straight story from them. If you look at actual history and what happens when they start having rate cuts, is typically the market sells off because smart money knows that, we are indeed in a recession. Bonds go up, stocks go down. So in my opinion, you should take profits. You should have been taking profits. And anybody who's come into our office in the last year and a half, my advice has been take profits, lock in, your hard work for the last 30 or 40 years, and make sure that you don't get bludgeoned by the next market crash. Lock in some income, create a plan where you don't have to make a lot of money in order to survive and do well. You just have to make sure you don't lose money to survive and do well. And I think the odds of losing money in the market are higher and higher every day that you wait and see what happens. So, how's the market going to react? I think there's enough smart money. The market is smarter than the public, and the market has already been divesting itself. I say the market makers, banks and everybody else have been divesting itself of so many stock holdings. And the private investor has increased those stock holdings. The private investor is always the one that gets hurt the most in market corrections. And, we're set up and poised to do so right now. I don't think, you need to be part of the problem. You could actually avoid the problem by just locking in, higher interest on some fixed type of accounts. You can also get into indexed products that have principal protection, no downside risk. And still, if I'm wrong and the market goes up, I was wrong last year. Well, I wasn't wrong. I still think a crash is imminent. I don't think I was wrong to not want to be all in the market because the risk is way too high. But, I said, I think the market could crash at any time, and it didn't. That doesn't mean I was wrong. It means it just hasn't happened yet, right? Well, the thing is our index products all made money last year. So that's good. Our index products made money. We made 4 or 5% on our safe money. Is that a horrible thing? Well, if you didn't lose any money, that's good, right? If you weren't expecting to have to make 10 or 12% a year or 20% a year in order to make a living or to live, high on the hog in retirement because you didn't save enough, but you need all this extra pressure to make your money earn so much money in order for you to keep your lifestyle, then maybe you're not in a position to retire as the way you think you should, because all you're doing is you're setting yourself up for failure. Anybody who goes into retirement thinks they're not going to have to endure a market crash and they keep their money in the market is very naive. If you look at history, we have a crash every decade, at least one, and there's probably going to be more than one in the next decade just based on how overvalued the market is. So, you're going to have, in a few decades, you're going to have to deal with some volatility in the market. There's going to be some reset times. There's going to be some recessions. They just happen. And we're at a time when there's a lot of factors pointing to the fact that we're stretching that rubber band a little bit and it's about to snap. When it does, I don't want to be in the way. My clients don't want to be in the way. That's why, we work together. If you are already thinking that way, you might be a little late in coming to that party because the market looks like it's been pretty weak for the last few months, and it just really can't get the momentum under it, even as much as they try to keep on propping the market up with buying futures and with saying they're going to have rate cuts and even lowering interest rates. It hasn't really done well to continue that big bull market that we have had over the past year up through about April of this year. So since then, it's been kind of choppy, and I think the road's going to be choppy until we have that correction that gets us back to fair market value, and that might happen within the next week or two or the next quarter or two, maybe sometime within the next year. But meantime, you can be in a place where you can't lose and still win if the market still has some upside. And if it doesn't, well, you're not going to lose in the meantime, and you're going to reset at a lower rate when the market resets, and you won't lose, and you'll have the full value of what you have now in order to reinvest in the market or basically take part in the market upside when it comes back.
Clay, thanks for listening to us in Savannah. We'll send you out Jeff's book, Retirement: The Road Ahead. And if you've got questions for us, get it to us by calling Shelley, 520-780-9059. She'll take them down for you. Or you can go to our website, which is premrat.com, and leave them there. If we answer them on the air, of course, you'll get Jeff's book, Retirement: The Road Ahead. You're listening to Premier Retirement with Jeff Fogan. Again, we invite you to call us, get in and sit down for your casual conversation about your journey towards a confident retirement. We call it the Premier Retirement Roadmap. 520-780-9059 is our telephone number. We would love to hear from you. Jeff, let's move on to our last topic here today, what to know before a spouse passes. We talked a lot about legacy planning many times, but it's unclear to me, Jeff, what happens when one spouse passes, leaving the surviving spouse to carry on. Can you give us a few details, a little insight into what people should expect?
Well, a lot of people think, the first thing comes to my mind is, guess what? When you're single, you're going to be a new tax bracket. So you've got to plan on that. That's a big shocker for many people. The other thing is depending on how much you're living on based on your investment income. Now, all the investments should still be there, generating about the same type of income that you are getting jointly. However, if a spouse dies that had a pension, maybe you're only going to get half of that pension, or maybe it's a pension that was only based on that person's life and you don't get any residual pension. If you have Social Security, you're going to lose the lower of the two Social Security paychecks. So if you and your spouse both make $3,000 a month on Social Security, you're going to lose $3,000 a month. If you make $1,000 and the spouse makes $4,000 and the spouse dies, well, you just lose your $1,000 and you keep the $4,000, so your income only went down $1,000. So you got to take into consideration. That's why we put everything out on a map. Our Premier Retirement Roadmap is basically a big spreadsheet that shows your life on one page that shows, each year and what would happen. You can plug in at any time. You can basically do an assumption of, okay, what if John Doe dies at age 80 and Mary's still alive for another 15 years? Is this going to be sustainable? What are we going to do to make sure that her income doesn't go down? Do we have to have life insurance in order to replace some income or replace assets in order to, create an income stream? Do we need an annuity that has a joint lifetime payout? Do we need an annuity that has a joint has a lifetime payout, but we don't take income and we allow that person to die with it, do a spousal assumption, roll it over to the spouse, and then turn on a higher level of income on a single life payout? Now, that was a lot of words. It probably means nothing to somebody that doesn't do planning every day. But the bottom line is there's a theory and there's a process in planning that you have to take in consideration, what happens. Now, most people don't die the same day. In fact, some people, like my mom, has outlived my dad by, 35 years or more, 37, I think. That's a long time for, dad's Social Security and pension to take care of mom. Well, it really hasn't. She's had to do that mostly on her own. And there wasn't a whole lot of assets. But, what if you have two incomes until, within a year or two apart? Well, that's probably an easier way to deal with it. But even though you have to, hope for the best, you also have to plan for the worst. What if right into retirement, one of you passes away in the first few years unexpectedly, or, get some sort of an illness or something that, limits life expectancy, and then you have to kind of change your focus and your plans. Some people are really, bent on trying to spend more money in the go-go years. And, if somebody dies right at the end of those and half the income's gone, that might really leave that person hanging, for the future. So you have to, play around with the numbers and play around with the different scenarios to make sure that your plan has enough buffer in it so that when one of you dies unexpectedly at an earlier than expected time, that the other one can carry on without having to sell the house or downsize or whatever. By the way, sometimes part of the plan of the exit plan would be, we've got a big house, we have all equity, we have no loans on it. There's always a reverse mortgage that a surviving spouse could also turn on some extra income and use home equity to live on. There might be, different ways that you can elect to take pensions out. I don't think it's a bad thing necessarily for a spouse to take the most out of your pension as you can on a monthly basis, hoping that you live as long as you can, but because you make extra money per month. But it would be smart to put that extra money per month in an investment or even in a life insurance policy where you can replace, maybe hundreds of thousands of dollars in tax-free assets that a spouse could use over, a 10 or 20 year period should that spouse outlive you. So, a lot of things to consider, but, and then remember that, you're going to be in a tax bracket that starts at half of where those brackets used to start. In other words, if you're in a 25% bracket and the bracket starts at 80,000 taxable, for a single person, it's going to be 40,000 taxable. So if you're still going to live because you have very similar bills, the only thing you'll really lose when a spouse dies is the food bill, really, right? Because rent and utilities and gas in the car and any payments that you have are probably going to maintain to be pretty much the same. So, your cost of living really doesn't decrease, but the amount of assets you have and the income coming in probably decreases at a much higher rate, and you have to make sure that you can, fill that gap.
So once again, if you have questions about when a spouse passes, 520-780-9059 is a telephone number. Once again, in summary, many times you're bumped into a different tax bracket because you're filing single as opposed to filing married. Your expenses many times stay the same, but your income is often cut in half, so that involves some planning, and certainly we can handle that aspect of your financial plan right here at Premier Retirement. If you'd like to get in and sit down with Jeff, talk about your individual situation, ask the tough questions on a private basis, 520-780-9059 is our telephone number. Once again, there's no cost, there is no obligation, there's no judgment whatsoever. So take advantage of this opportunity. You can make that call this weekend, as in right now. 520-780-9059. Leave your name, telephone number. Shelley will call you back during the week and set up this appointment for you. And again, no cost for this whatsoever and no obligation. 520-780-9059 or online, visit us at primret.com. Well, Jeff, we just get started and we are out of time for the week, and that's the case right now. So for Jeff Ogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.